Hello everyone, today's video is all about ISAs, individual savings accounts. Why are we talking about ISAs today? Well, we're only a few days away from the end of the tax year on the 5th of April. So ISA is a great way to save tax, but you need to get the money in before the 5th of April. So let's dive straight in. What do we mean? 4 types of ISAs: cash ISA, stocks and shares ISA, innovative finance ISA, and lifetime ISA. So the cash ISA, I think most people are familiar with that. You just invest in a cash account within the ISA wrapper. Interest is tax-free, but rates of interest very pitiful at the moment. Stocks and shares ISAs. You invest in all sorts of different types of investments. Shares, government bonds, corporate bonds, unit trusts, investment trusts, a whole range of things you can invest in within the ISA wrapper. Innovative finance ISAs. Now this is for things like crowdfunding, peer-to-peer lending. You can hold those types of investments within this innovative finance ISA. And then the 4th type of ISA is a lifetime ISA, which is aimed at helping people to get on the property ladder, where the government contribute a certain amount in. Now, I've done separate videos on innovative finance ISAs and lifetime ISAs, and really there's not much to say about cash ISAs, apart from the fact they're not very good, but mostly concentrate on the stocks and shares ISAs on this video. So £20,000 a year is the limit. You always, if you can, try and max as much of that limit as possible. For wealthier individuals, they would choose to put in 20 grand every year. If you can't afford to do that, do try and put in as much as you possibly can, because it is a use it or lose it allowance. It doesn't roll forward from year to year like the pensions allowances do. Use it or lose it on an ISA, 20 grand a year, then it's gone, then the clock starts again next year. So why is it so good? It's so good because 2 main reasons: the yields and the growth on the assets within the ISA are tax-free. So let's say you invest in stocks and shares and you've got a portfolio of companies and they are paying dividends on those shares. No income tax on the dividends, no capital gains tax when you sell the shares within the ISA wrapper. Unlike, say, holding stocks and shares conventionally outside of an ISA wrapper, well, then you would be subject to paying income tax on dividends and capital gains tax on selling the assets if indeed you exceed your annual allowance for capital gains tax. So very tax efficient. When you pull money out of your ISA, again, there's no tax. So that's why, as a tax planning tool, they are so good, and hence the reason for prompting you all to think about it, because we're nearly at the end of the tax year. And so if you do have a few quid to spare, which hopefully you've saved a bit during the pandemic, well, do consider investing it rather than spending it, consumption. I mean, I know it's tempting, but these are, it's an ideal opportunity to put some money away into savings, and ISAs is one of the ways to do it. Now, the ISAs have been around for many years now, but what is and the limits have gone up, £20,000. It's been kept the same for a year now, but it's still a generous allowance to put in. If you are a parent and you're feeling very generous towards your offspring, you can also contribute into what's known as a junior ISA, and you can put up to £9,000 a year into a junior ISA. Cash ISAs and stocks and shares ISAs. The lifetime ISAs and the innovative finance ISAs are not available to kids, but basically you can contribute into their ISA, the junior ISA, until they are 18. The only drawback is that legally they can get their hands on the pot when they are 18, so they could decide to just take everything out and cash that ISA and blow it all, which is obviously what you don't want. So an alternative would be to put money into pensions for your kids. The amount you can put in a year is not as much as the 9,000 under the ISA, but they can't get their hands on it until they reach 57 currently. So just a thought for saving for the kids. But yeah, do consider the ISA. Like I said, no tax on those yields, so you don't put anything on your tax return for dividends or interest or capital gains. It's all tax-free, and it's tax-free growth, and it's tax-free when you take it out. So that's just an overview on ISAs, getting close to the tax year. So if you have got a few quid, do think about putting it in an ISA. If you like this video, please do subscribe right there, and I will see you soon.